So welcome back, everybody, to another webinar organized by Princeton for everyone worldwide. We're very happy to have Alan Auerbach with us today from UC Berkeley. Hi, Alan. Alan will talk about international taxation in a digital world, and we're very excited to learn about this. It's a very hot topic and very, very important going forward. Before I go to the poll questions, for the questions Alan asks before, I will give you a little overview and introductory remarks. And I would like to start with Richard Musgrave, one of the giants in public finance. And he always identified essentially three main aspects one has to focus on: allocation, redistribution, and stabilization. So allocation is all about efficiency, how to allocate resources efficiently over time and across a space and people. Redistribution is about fairness, and stabilization is about resilience, something which we focused on quite a lot in this webinar series. And of course, in terms for taxes, it's also important to have the administrative costs in mind and international aspects. And Alan will focus a lot on the international aspects today and also on the digital aspects. Now, in terms of taxing, one of the first things I've learned as an undergrad was essentially the Ramsey Rule. Of course, we can tax land, labor, and capital, but what we will focus on today is essentially capital has a tangible aspect to it and an intangible intellectual property rights and so forth with it. And we know, of course, from Ramsey's rule that we should tax more what is less substitutable or less mobile in order to minimize the distortions, except if you have environmental aspects and other externalities in it, then you would like to have distortions, but typically we would like to minimize distortions across factors and also across time. And that across time is big implications on the optimal capital taxation. But then there's also how to tax the super rich. And the super rich essentially are the most mobile, so they can move from one country to the next, from one state to the next, and avoid taxes. And at some point, Tony Atkinson made this proposal, informal proposal, that the way we should tax the super rich is to the country should form a club and negotiate with the super rich, and then split the tax revenue according to GDP or some other key. And that's what he proposed. And the question is a little bit: can we extend this also to the super rich corporations as well? Should we extend this Atkinson proposal not only for super rich people, but also super rich entities? And another idea is essentially that what governments do, they enforce intellectual property rights. And that's one getting more and more important component of capital. And you can charge for that in form of taxes. But if you think about corporation tax, the way I think to think about it, it's at the end of the day, ultimately all the taxes are paid by people. And if corporations pay some taxes, indirectly it's paid for on behalf of the shareholders. And what you really do by hiking the corporation tax, you essentially impose a higher tax on the tax-exempted sector, because the tax-exempted sector, like university endowments and others, hold essentially some of these corporations. And if you tax the corporations, this tax-exempted sector has to pay some of these taxes as well. And then there's, of course, an international dimension to it, because you have domestic shareholders and foreign shareholders. Now let me move to the international component. So the question is, what should you tax? What should be the tax base be based on? Should it be in the shareholder's residence, the person who holds essentially the shares, where does he live? Or should it be the headquarter of the company? Or should it be the source or the origin where the value is actually created? And that's the whole complication. That actually, ideally, you would say, where the value is created, that's where the tax should be levied on. But if you have global value chains, if you have data, is it where you run the regressions or do some machine learning algorithm, or where they do the marketing efforts and all this? So it's very hard to determine. And then the fourth option is essentially you tax, the tax base is where the destination is. Like if you're value-added tax, that's what you do. And I'm sure that Alan will talk about DBCFT, destination-based cash flow taxes. One thing I've learned from preparing for that, acronyms are very common in this tax space. And another one acronym, I hope Alan will enlighten us, is the GILTI, which feels, you have to be guilty already. tax, which also is about international tax competition, which is like a minimum tax imposed on. And then there's another dimension which comes up in climate change, which debated a lot in Europe, is the border adjustment tax. If Europe is imposing certain restrictions and taxes, a carbon tax, and other countries don't, how do you adjust at the border that the European companies are disadvantaged from that? And is this actually correcting some distortions, or is this some hidden protectionism? And we would like to get some idea about these aspects as well. And then there's a whole digital space. There's a whole debate about DST, another acronym, digital service tax. You know that Google and Apple and all these companies do this double Dutch and Irish and other tax tricks. How should we react to that? Should we just fix these loopholes and get rid of it? Or should we just redesign the whole global tax architecture? And that's a big question. Do we have to go radically and redesign the whole global tax architecture and fix the whole loophole? And my impression is, if you really want to tax it, you can. It's just a lack of political will. And if you want to tax it, I think you can just, make life so difficult for a company to operate and sell the products in a country, but that you can actually tax it. But then the other question is, is what's the rationale for the digital service tax? It's like the money grab hypothesis. There's all these rich American tech companies out there, and you also would like to have a part of that. And is this the rationale, or is it because these companies may have excessive rents? There's a concentration of power. We don't like concentration of power, so it should be with the people. Or is it just some populism that some people say that the revenue from the DST would be tiny and not really substantive. So it's more like, to please the public, and it's a form of populism. And then there's another aspect to it, which I would like to raise, is like, typically we'd like to subsidize innovation. So we'd like to subsidize sectors which really do a lot of R&D investments, because all the R&D creates a lot of positive externalities for the rest of society. And why do we want to tax a sector which is very R&D intensive and is pushing the frontier dramatically? So that's another aspect. Of course, you might argue you can tax the sector and then reinvest, because part of the sector, the dominant players, they have, conduct killer acquisitions. They really don't promote innovation in a general competitive way. So you tax them and then you foster some new innovation from other companies. But that raises the question, is the government better in deciding which way innovation should go? Is the private sector better than that? And all these questions are fascinating questions. We hope we learn a lot today. And before we give the floor to Alan, I just would like to give the results from the poll questions. And thanks to everybody for participating for these poll questions. So the first question was, given international taxes, the preferred US corporate tax rate from a US national perspective should be, according to your opinion, at the current level, 21%. I think that's just the federal, and then there will be a state tax on top of it. Should be substantially lower or substantially higher? And the answers were, should be stay at the current level. 55% said this. So that's reflecting already the Trump tax cut. 20% think it should be even lower, and 25% think it should be higher. Okay. So what's about the second question? The second question is about should actually, given its need for additional tax revenue, which probably given the expenditures we have to levy some taxes, given the international tax competition, should the US adopt some value-added tax? And 57% think yes, 35% think they disagree with it, they don't think so, and 8% were not sure. And finally, I think, which is the international tax cooperation, will it likely lead to a stable, coordinated international tax system that deals with all the challenges I just outlined, and Alan will talk about, including the digital services? And people agree with that. And that's actually 58% think, if I got this right, they agree this will be, getting there. So quite optimistic. The disagree, 25%, and the 70% are not sure. I probably am not sure, I have to admit. But I don't know as many things as Alan. And so we are curious to learn what he thinks, and whether he has a very optimistic perspective on it or is more pessimistic. So Alan, the floor is yours. We're looking forward to your presentation.
Thank you very much, Marcus. Let me begin by sharing my screen. Good. I thank you very much, Marcus. Let me begin with two introductory comments. First of all, it was a pleasure to hear you lead off with a reference to Richard Musgrave. Richard Musgrave was my first public finance teacher, and I also had the pleasure of teaching public finance with him for a couple of years just before his retirement from Harvard. Second, much of what I'm going to be talking about relates to the ideas of relate to a book that I recently published with Oxford University Press with several co-authors. That book, through an arrangement with OUP, aside from being available for purchase from them, is also freely available online, PDF version. And you can download the PDF version either from my personal website or by going to the Oxford Center for Business Taxation. Both will give you a link that you can either download the entire book or chapters in the entire book. Okay, well, Marcus has very nicely laid out the very complicated issues relating to international taxation. And I'd like to start with a picture that many people may have seen. This is an evolution of the G7 corporate tax rates from OECD data. And this includes, for the US and other countries that have subnational corporate taxes, the all-in corporate tax rate. So for the US, the current tax rate is higher than 21% because it includes the average state tax rate as well. You can see in looking at the G7 countries that there's been a steady downward march in the headline corporate tax rates. If you go back to the early 1990s, tax rates were generally in the range of the low 30s to the high 50s. And if you go back further, you'd see that they were fairly stable before that, moving around a little bit. But this kind of downward trend is really a phenomenon of the last 25 or 30 years. I've put Ireland in this picture too, just as a reminder that this is a matter of tax competition, increasing tax competition among countries. And one of the ways in which countries compete for corporate tax bases, which are mobile, is by lowering their corporate tax rates. We tend to think of Ireland as one of the, you might say, one of the perpetrators in this game of tax competition. But if you go back into the early 90s, that wasn't the case. Ireland had a tax rate above 40%. It was right there in the mix with other countries. And it's really since then that Ireland and many other countries have lowered their tax rates substantially. But Ireland isn't really an outlier. If you look, for example, at the United Kingdom, its current corporate tax rate is quite low as well. So this isn't simply an issue of tax havens versus other countries. It's a worldwide phenomenon. And even countries like France, which one thinks of as seeking to have very high taxes as a share of GDP, has been lowering its corporate tax rate. So it's clear that something has been going on. And I want to talk a little bit about that before getting into what some of the solutions might be. So what has been changing? Well, it's really a change in the nature of economies. These next couple of slides come from a paper I wrote a few years ago. So the years will need to be updated a little bit, but you'll get the picture. So if one goes back to the United States in the mid-1960s and says asks what were the 5 leading companies by market capitalization, they were names that to a lesser or greater extent are still familiar: AT&T, IBM, General Motors, Exxon Mobil, it was Exxon at the time, and Eastman Kodak, which made this funny thing called camera film. Now, AT&T still exists, but it wasn't the same AT&T. This was the pre-breakup AT&T, also known not really affectionately in the United States as Ma Bell. This was the regulated monopoly that provided all telephone service in the United States and also sold people their telephones. So it was a very large regulated monopoly, not the AT&T we have today. And aside from AT&T, what all these companies have in common, they make things. They make tangible things, whether it's computers or cars or petroleum products or camera film and cameras. And so they made things that were tangible. The location of the production was pretty easy to observe. Okay, let's go to 50 years later. And the 50 years later, there was one carryover, ExxonMobil, but the other are all intellectual property companies, where the value added is mostly associated with intangible assets. And these are, of course, you may, or most of you will know that Alphabet is the parent company of Google, and all the other names are, of course, quite familiar to all of us. Now, if I had jumped ahead a couple of years, Facebook would have, and so this is where we are now. And so these five companies, Apple, Alphabet, Microsoft, Facebook, and Amazon, are often talked about as a group. When talking about digital taxation, when talking about difficulties of taxing intellectual property. Just to reinforce the picture given by these two lists, just some other statistics drawn from a paper I wrote a few years ago. Over that same half century, the share of intellectual property in measured U.S. non-residential assets, whether using data from the Fed's flow funds accounts or the Bureau of Economic Analysis, doubled. And that's likely a considerable understatement, because the category intellectual property is narrower and doesn't include certain elements that we would think belong in the category intellectual property. The share of before-tax profits of U.S. resident companies, that is, companies with headquarters in the United States, coming from overseas operations, nearly quintupled. And so the rise of the U.S. multinational, if you like. And the share of cross-border ownership of equity has steadily increased. So this is from a paper by Steve Rosenthal in Tax Notes, showing the share of equity either directly held through foreign direct investment or held through portfolio investment by individual investors. Both of these have risen steadily, particularly in the last 25 years or so. And so a couple of things to conclude from that. U.S. companies we've had the rise of the use of intellectual property. We've had the rise of U.S. multinational companies producing around the world, earning profits in many locations. And the nature of the companies as U.S. companies is somewhat fuzzier now, because these companies have shareholders around the world. So what are the implications of these changes? First of all, there's an increased pressure on tax systems that, as is traditionally the case, are based on where corporations have residence. So of course, it's natural to think of individuals as having a residence. I live in the United States, I might live in another country, but legally, corporations have residence as well. And the companies I was just showing you, the high-tech companies that are now the biggest in the US, are all officially US resident companies. That is, they have their headquarters in the US, and by other criteria used by the US tax system are identified as US resident companies. But the meaning of that is, whereas we might think of individual residents, of course they can be mobile too, but for companies, it's always been a somewhat more forced idea to talk about where the companies are resident. But now that companies are really operating around the world, and have shareholders around the world, the idea that they're have a fixed residence in one particular country is more forced than it was. And what that means is that it's easier for companies to change their residence, for leaving tax rules aside. It's easy for them to change their residence and still maintain the kind of operations they want to maintain. If a company has operations around the world and shareholders around the world, why does it need to be a resident of the US? And that encourages them to engage in a corporate inversion if being a resident of a particular company, as is true for the United States, was especially true for the United States before 2017, then they can move and they could engage in a corporate inversion, which basically means reorganizing the corporate structure so that the parent company is no longer resident in the United States. And here's just a picture of the count of corporate inversions in the United States. And there have been ups and downs because there's been sort of a guerrilla war between the corporate sector and the US Treasury trying to figure out ways of making it more difficult for companies to invert. Initially, it was possible to invert simply by changing corporate structure. After 2004, it was typically when a company needed to go through a merger with a foreign company. And after 2014, even mergers became a little bit more difficult to use, but not impossible. And companies continued to use inversions. And what really slowed it down was the 2017 legislation, which made inversions less attractive from a tax perspective. But the conclusion from this discussion is that corporate residence is a less stable, meaningful concept than it used to be.
Alan, can I ask you a quick question? So
sure.
I would like to know, you mentioned that intellectual property rights is very, very important.
Yep.
But he thinks it might be equally important that these firms have some network effects and the nexus to networks. That's where the value creation comes from. Does it make a difference in your argument?
Well,
it's IP or network effects?
I think IP, the network connections associated with IP are important, and it's actually something that facilitates tax avoidance by companies. It's having operations in many countries. It makes it more difficult for tax authorities to enforce tax systems, and I'll be saying more about that. Mm-hmm. One of the other characteristics of residence-based taxes that was unappealing in the U.S. Prior to 2017 was the fact that there was a tax. The U.S. had a traditional residence-based tax that taxed companies when they repatriated earnings, and as a result, U.S. companies hoarded huge amounts of income, kept it overseas, at least 2.6 trillion as of 5 years ago, and that was something that clearly was unappealing about the U.S. tax system and led to a change. That's no longer true. Another implication of the changing landscape of corporate activity is that there's an increased pressure on tax systems that are based on source, on where companies produce. So, it wasn't very hard to figure out where GM was making cars. And it may have made them in other countries. It didn't operate solely in the United States, but if a car was made in Canada as opposed to the United States, it was pretty clear that it was being made in Canada. Now the location of production is easier to modify that is, the company can report the production or the profits is being earned, the production is occurring in a different country because, it's through the supply chains, it's adding value everywhere. Where is an iPhone produced? Well, it's produced in a lot of places. And it's even harder to say where the services that a company like Google provides are produced. So with using intellectual property and operating in many places, it's hard to determine where a company is producing, and therefore it gives companies more access to tax avoidance technology that induces it to report that it's producing in places where the tax rates are low.
So James Brogan would like to know, do you think that the taxation also affects the design of the global supply chain? So we know that global supply chains make it very hard to determine and easy to avoid taxation, but does it go the other way around as well?
Oh, I think absolutely. There's no doubt that some of the activity in the Republic of Ireland is attributable to taxes. Now, Ireland has other advantages. It's a relatively low-cost producer in the European Union. And therefore, for companies that want trade access to the European Union, it's good to work there. It has an educated English-speaking workforce. And so there are other attractions to Ireland. It's not simply a tax haven. On the other hand, the fact that it is a low tax rate country makes it more attractive to operate there. And so it is hard to say what came first, or whether the things occurred simultaneously, but all of it has been facilitated by the fact that it's feasible to produce in many locations. If this were the automobile industry, it would be more difficult to modify the supply chain locations simply in response to taxes.
And then there's often the argument that, you know, the tax rate, the corporate tax rate in the US went down, but the tax revenue as a percentage of GDP didn't go down much. It's just,
well, that is after all the point of tax competition, that if tax base is mobile and you're low, and other countries lower their tax rates, then you know, you may actually do better, conditional on what other countries have done, by lowering your tax rate too. In addition to identifying where companies produce, there's also a separate question, which is where their profits are earned. So in addition to locating some of its production facilities in Ireland, a company might report higher rate of profit on its capital and revenues in a country like Ireland than in the United States. And so separate from where the production is locating, there's a question of where companies report their profits. And profit shifting is easier because when in the current environment, because it occurs through related party transactions, whether through joint ventures, intra-company borrowing, or transfer pricing manipulation, where a US parent and an Irish subsidiary have a transaction where one is buying something from the other, and they can either inflate or deflate the price relative to a, you know, sort of arm's length price in order to shift profits from one country to another. And that, what does that require? It requires having a related party in a low tax jurisdiction, as well as having a transaction in something where it's difficult to determine what the value is. So if selling steel to a subsidiary or purchasing it from a subsidiary is not very easy to manipulate the price, because we know what the world price of steel is. We don't know what the world price of idiosyncratic intellectual property assets is. And so it becomes much easier to shift profits. Here's an estimate from a NBER paper a few years ago of the extent of profit shifting that was going on in the world, based on looking at where companies had their labor forces and where they had their revenues, and using that as a measure of the quote unquote true location of their profits, and then seeing where their profits were actually reported. This is for US companies, and the plus $280 billion for the United States says that the US was reporting that much too little. That is, this is how much profits would have increased if one adjusted for the profit shifting that was going on. There's been some dispute in the literature, and I have a few sites here on slides with hyperlinks. There's been some dispute in the literature. The last paper by Bluin and Robinson suggests that some of the methodology that's been used in some of the high profile papers in this literature may overstate the extent of profit shifting. So whether it's this big or smaller is, I think, subject to some uncertainty, but there's no doubt that a lot of profit shifting is going on. The newest challenge is not simply companies that use intellectual property, such as, say, Apple, but companies that provide digital services. So think here about Google or Facebook. So the problem is that there are a lot of countries that have a sense that Google and Facebook and companies like them have a big footprint in their countries. They have a lot of users, a lot of eyeballs on their sites, and their residents buy a lot of things based on advertising that are on these platforms. And yet, given the way international tax rules work, these countries don't collect any revenue from Google or Facebook, because by the standard rules, they're not resident in these countries. They don't do any production there. They don't report any profits there. And so what are these countries doing? Well, starting with countries like France, India has done it, other countries have done it in recent or are considering it. They basically have adopted add-on special digital taxes, typically excise taxes, typically based on either the companies' advertising revenues, and based on a share of, what fraction of users are in their country, and multiply that by the revenues of the country, or use some other measure based on how many people in the country are, how important they are as users of the platforms. One of the current challenges is how to reconcile these with the process of more fundamental tax reform that's being pursued worldwide, and whether these taxes, incipient taxes, should be folded in to the a new system that's adopted, or whether they should be freestanding.
Can you give us an idea how big are these taxes in terms of revenue? Are they tiny?
It's a little hard to say. There are typically a few percent, that is excise taxes of a few percent. They're just starting, and so it's a little hard to say how much revenue they're actually collecting. In a sense, they represent, you might think of them as representing threats, rather than, I don't know how many countries really think that these are going to be taxes ongoing. I think the OECD initiative for tax reform intends to fold these into a way of modifying the corporate tax.
So it's more bargaining.
I think of it that way. I mean, they are in law. They're not strictly just threats, but how much revenue we'll see collected from these over the next few years before they're repealed and folded into a revised tax system. But I don't view them unless the tax reform negotiations completely break down. I don't view them as a long-term part of tax systems. So what can countries do? One, and Markus mentioned subsidizing R&D. One thing countries have been doing is enacting things called patent boxes. Think of a box as a box into which you put certain kinds of income. Many European countries especially have adopted favorable tax regimes for intellectual property income, where they say whatever our corporate tax rate is, income attributable to intellectual property income will be taxed at a lower rate. Now, there's two rationales for this. There's a traditional rationale, which is to say, to the extent that companies are developing intellectual property, there may be positive social spillovers, and we should therefore encourage that activity. But you can do that through other mechanisms like R&D credits. I think what's really driving patent boxes is the idea that the income associated with intellectual property, for reasons I've already discussed, is more mobile than other kinds of income. And therefore, it's really just, if you like, a form of Ramsey taxation, where you impose a lower tax rate on a more mobile factor. But it's still a form of tax competition, because countries use lower patent box rates to compete with each other. And indeed, there's not a bright line between intellectual property income and other kinds of income. And so companies are encouraged to classify other kinds of income as intellectual property income. Moreover, there's actually very little evidence that companies are actually relocating their R&D activities and that lead to patents and other kinds of intellectual property values, as opposed to simply relocating where they keep their intellectual property as a way of reporting their income. So my guess is that this will not be seen as a stable, long-run part of a tax system. A second approach is to just be tougher on companies. So Markus said that it's a matter of will, and that is certainly a philosophy that many countries are taking, which is, look, we're choosing by our inaction to let companies play games with us and report income that they should be reporting in our country elsewhere. We'll just tighten the rules. We'll tighten our oversight of intra-company transactions so that they can't shift profits abroad. and maybe we'll, do other things that make it harder for them to report low income in our country, even though we think it should be higher. Evidence on this suggests it does work to reduce tax avoidance, and there are recognized ways of doing it, but it has other adverse effects as well, and that's what the evidence also suggests. So to give you the intuition, if I'm a U.S. Company or another company operating in the U.S., and the U.S. has relatively lax rules applying to tax avoidance, so it's possible for me as a corporation to sort of hide half of the income I earn in the US in another country, then the operations that I do in the US will effectively be taxed at a much lower rate. And that means I may be more willing to invest in the US because I know that the US is sort of going to wink at me when it comes to collecting taxes from me. That may seem unappealing. On the other hand, it may, in some circumstances, represent an efficient approach to taxation, particularly if multinational companies have more mobile tax bases than, say, companies that only operate domestically. And then it's a ad hoc way of imposing a differential tax system for different kinds of companies. Not necessarily the best, but it's one that you would want to think about before moving against it.
But can you imagine that for popularity reasons, you increase the tax rate, but then you make it easier to avoid it?
Well, in a sense, that's what we did at the individual level. If you go back several decades, we had much higher top marginal tax rates and much weaker certainly before the Tax Reform Act of 1986, much weaker rules about tax shelters and things like that. And so we had a lot of people who had apparently very high marginal tax rates, but actually weren't paying a lot of taxes. And so we could do that. I think part of the problem is that we then get into outrage. There were hearings before, a couple of years before the U.S. 2017 tax reform. I think there was a hearing specifically targeting Apple. For basically doing things. These companies are typically audited annually, large U.S. corporations. It's not as though they're engaging in outright tax evasion because everything they do is being observed. It's simply that the rules allowed them to avoid paying taxes in the United States, and there was outrage about it. And so I think the idea that companies will choose not to respond to incentives to avoid taxes is, I think, a little bit weak. And if it leads to outrage, it's not really a stable outcome either.
So economic rationale for taxing mobile companies who are very easy to move abroad because they are very intellectual property focused, international property right focused, is essentially the Ramsey Rule, or?
Yeah, I mean, I think you could think of that from, now I'm going to be coming back to the issue of cooperation, but if you're thinking of an individual country acting on its own, it's hard to justify trying to impose a high tax on a very mobile factor. Yeah. And then that is why companies, countries, even countries that we think of as not having a political reason to have low taxes on corporations have been lowering their tax rates. Another approach is to say, well, taxing based on location of production isn't working, and taxing based on residence of company isn't working. So let's try a combination, and that's what the U.S. now does. In 2017, we adopted a territorial system. We got rid of our worldwide system, but then we put back in a worldwide minimum tax based on accruing income. And that's the so-called GILTI, Global Intangible Low Tax Income approach, which basically says we're taxing everybody who operates in the U.S. on their profits earned in the U.S., but we recognize that that's going to give U.S. companies an incentive to report their profits elsewhere because we don't have a worldwide tax system. So we're going to have to put something in to discourage them from shifting their profits to other countries, and we'll do that through a relatively low rate minimum tax on their operations. And it's also something that's being recommended by the OECD. They have a two-pillar set of proposals in their second pillar, their pillar 2 proposal. Now, just to point out, this approach it may lessen, because if you're doing a little bit of two things rather than relying solely on one system, you may not have the worst of any one system, but you still have some of the problems of each of the systems that you're using. So it doesn't eliminate the problems of the existing systems, including the incentives for tax competition. And the potential for stability, particularly for thinking about the approach the OECD is taking really hinges on the ability to enforce cooperation. So Markus mentioned Tony Atkinson's proposal to have a club. Well, if you want to have a club of countries that try to impose similar taxes to keep companies from sort of shopping for residence and choosing a country that has a low minimum tax rate, countries have to have relatively similar minimum tax rates, or at least the countries where the company might want to be resident. And that's only going to work if they all cooperate. And countries have different incentives. If you're a country that is desperate for capital and has a lot of willing workers and educated workers, like Ireland, for example, they might not want to participate in a cooperative process that requires them to have a relatively high tax rate. They may say, look, we want capital and we want to attract it, and we're not interested in having a higher tax rate. And so once you have heterogeneity in the population of countries, not in terms of their attitudes toward tax avoidance, but in terms of their fundamental economic characteristics, it's going to be harder to get cooperation. A fourth approach, and one that I favor and that we put forward strongly in the book, is to focus on destination, that is the location of final consumers. And the argument isn't that there's any kind of moral or ethical argument for taxing based on where consumers are. It's simply that consumers are a relatively mobile tax base. It's true, people can move from one country to another, they can go to another country to go shopping. But the evidence from the main tax, existing tax around the world, not in the United States, but virtually everywhere else, the VAT, the main existing consumption tax, based on where consumers are, is that there's relatively little problem with tax competition. That is, countries set their VAT rates as they wish to raise revenue, and maybe if there's an open border with a nearby country, they worry a little bit about it. But there's certainly no concern. The U.S. would, if it had a VAT, would certainly not be concerned about what the VAT was in Ireland or in the Cayman Islands or any other country like that. So using that logic, it's not as though there would no longer be tax competition of a kind, because if, for example, the US said we're going to scrap our corporate tax system and adopt a destination-based tax, either one of the kinds I'm going to talk about or just a VAT, because there'd no longer be any tax based on corporations operating in the US, just not selling, but just operating in the US or having residence in the US, it would involve a kind of tax competition, because the US would now say we're open for business, and if you locate your production or profits here, you don't have to worry about any extra taxes. But it's not a competition over tax rates. It's a competition over tax systems, because the US would be saying we're choosing a different tax system which doesn't discourage companies from locating their activities here, but we're still going to raise as much revenue as we want. We're just going to do it in a way that doesn't involve tax competition, that is, if everybody did it. And this reflects an additional objective of tax design, other than efficiency, administrability, equity, all the things that Richard Musgrave talked about, which is something that's familiar from other aspects of economics, which is incentive compatibility, which is not, is it, can we come up with a system that countries will want to adopt on their own? And indeed, if other countries have adopted it, the countries that haven't adopted yet will feel pressured to follow suit. So if the US may want to adopt a destination-based tax on its own, and once it does, then Germany and France and other countries that may be in competition with the US for production activities may feel an even stronger incentive to adopt such a system.
What's the political feasibility? How would you sell it to the public to switch from a corporate tax to a VAT?
Having tried to sell this to the public, I would say a few years ago, I would say it's not necessarily an easy sale. It depends on how foreign the concept seems. The public in this context includes tax lawyers and administrators. Mm-hmm. And I can tell you from experience that they think they understand how tax systems are supposed to work. And if you say, well, I'm going to go for a VAT, they'd understand that. But if you say, here's a new tax I'm proposing and it's something we don't have, that may be a little bit more difficult. But I think this is one of these things where by experimentation, by gradual changes, people become comfortable with things they were previously not familiar with, and that's how it's likely to work. So the two approaches that we put forward in the book, adopting destination-based taxation are, and here come the acronyms. The second is one that Markus mentioned, the destination-based cash flow tax. And the first is what we call the residual profit allocation by income. And the main difference between these is that the RPAI is an incremental approach. It's saying, okay, suppose we're dealing with a reality that says that tax administrators and the public more generally just aren't going to be comfortable with a major change in the tax system. So we're going to work incrementally, but in the direction we think we should go. The second is to say, let's start with a clean slate, ask what kind of tax system is best, and work with that. So the first system basically says, well, let's go with the current systems the way they work, allocate earnings based on routine operations. So those, the automobile production, the production of tangible things, and we'll allocate them the way they were allocated in under current law, because we know where they're being produced. We know what a reasonable rate of profit is to be declared on these. We don't really have much of a profit. But that's going to leave a lot of residual earnings. And for companies like Apple and Google and Microsoft, it's going to leave most of their earnings. And for other countries, maybe not very much. Other companies, not very much. And for these earnings, and this is the problematic component of earnings for existing tax systems, we're going to allocate those based on the location of sales revenue. And that's where the adoption of the destination-based approach works. Now, the US states have essentially been doing this. They have systems of formula apportionment. They're not allocating just residual earnings, they're allocating all earnings of corporations in the United States. And historically, they did it based on three-factor approach using where their assets, companies' assets were, tangible assets were, where their labor payroll was, and where their sales were. And in most states have moved to sales-only apportionment, which is a way of illustrating that the stable equilibrium in a tax competition game involves moving toward destination. The RPAI system, as we describe in the book, it has the advantage of being incremental, but it doesn't get you all the way there. There's still some problems in terms of profit shifting and production shifting, not as big as under the current system. And there's still some strategies for tax avoidance that don't go away. So we view it as a big step forward, but not necessarily the final step. And I should add that this is pretty close to what the OECD is now proposing in its Pillar 1. Although I think our approach is cleaner and more coherent. And I think the OECD's approach, in some sense, arises from them trying to please heterogeneous group of constituents who have different national interests, and I think in the end it's going to prove to be an unwieldy approach. And if they do adopt Pillar 1, I think it's going to be closer to what we've proposed. Now, the destination-based cash flow tax, which was basically considered seriously in the United States and a few years ago, would be a cash flow tax on domestic operations with border adjustments, not for environmental purposes, but just the way they work under a VAT, where exports are relieved of tax and imports have tax imposed. And what the border adjustment would do is it would take you would say, well, if starting from a VAT based on where the production occurs, it would shift it to where consumption occurs. Because unless consumption occurs in the domestic production occurs in the country, it won't be taxed. And anything that's produced abroad that is consumed in the country will be taxed. So another way of thinking about the destination-based cash flow tax is if you could start with a VAT and provide a deduction for wages, you'd be there too. It's basically a tax on profits, and it's attractive in that way because one of the things many people worry about with a VAT is that it's not progressive. And of course, if you take wages out of the tax base and retain just a tax on profits, then it does become progressive the way the corporate tax as at present likely is. So why wasn't it implemented despite my best efforts in 2016 and 2017? Perhaps I wasn't a very good salesman, nor were others who were working on this. But I think the fundamental problem, I think, was that it was too different from the tax system that the the U.S. has now, which is the general lack of understanding of the plan's operation incidence. It was frequently misinterpreted what it would do by companies that thought they would gain that actually wouldn't, and companies that thought they would lose and actually wouldn't, and by tax practitioners who just thought this was strange. There was concern about a possible WTO reaction, which always struck me as strange because, as I said, you can think of this tax as a value-added tax and a reduction in labor taxes, both of which are WTO compliant, but somehow if you put them together, there was concern that they wouldn't be. And there was, from economists, there was concern about the fact that it would likely work most smoothly if there were an nominal exchange rate adjustment that occurred rapidly with adoption of the tax. And there was some concern. Frankly, I was less concerned than others, but there was some concern among some economists that the nature of the required exchange rate adjustment would cause short-run economic disruption.
Is there a way to implement it in a gradual fashion instead of a big bang?
Well, that was certainly considered, but one of the issues you have with that, particularly thinking about the exchange rate adjustment, is that exchange rates move immediately. And so the cleanest way to do it would be to have an unannounced change and have fully flexible exchange rates that immediately respond in the way that is necessary. But if you say we're going to phase this in over the next 3 years, you have an immediate exchange rate adjustment, which would actually worsen competitiveness in the short run. And so, unless you adopt it gradually and people don't realize you're doing it gradually and just think each one is a one-off change, there's a problem with that. And that was something that we never got beyond.
Can I ask another question? For both of these approaches, typically a big problem is that we favor debt funding over equity funding.
Yep.
That leads to huge distortions in the economy. Which of the two approaches would solve that problem?
The destination-based cash flow tax would have eliminated the interest deduction, and so it would have solved it sharply and cleanly. The other one, it would be a matter of choice. Just as you could have a reform of existing tax systems to make more neutral debt versus equity, you could do that under the RPAI, but it was an integral part of the DBCFT. Now, the U.S. In 2017 stepped back from the DBCFT, but in a sense, it didn't fully, because it included various components that were part of the DBCFT proposition. We introduced expensing of some investment. There were also some restrictions on interest deductions that haven't received a lot of attention, but were included in the legislation. There is now a partial tax on related party imports, which has another acronym BEAT, which I suppose is appropriate given what it's doing to the companies. And then it has a tax reduction on some exports of so-called foreign-derived intangible income, so you can think of the BEAT and FDII proposals as, narrower partial border adjustments of the kind that were included in the DBCFT. So a lesson that I learned from this process was that there are actually is a compelling incentive for a country like the US to go in this direction. And it just found its own way to go there rather than going all the way there at once. So where does that leave me? Well, it leaves me thinking that we are moving in the direction of destination-based taxation. And we're doing it in fits and starts. We're doing it through digital taxation. We're doing it through unilateral partial actions like the United States adopted in 2017. We're doing it through attempts through Pillar 1 in the OECD of cooperative approaches. I'm not sure which of these approaches is going to win out. I think I'm a bit more skeptical than the audience poll participants that international cooperation is going to work, because the cooperation will be required by a large number of countries with heterogeneous interests. But I think it'll be interesting to watch what happens under the Biden administration, which is pursuing two tracks. It is participating and supporting the OECD process of cooperation, but at the same time considering its own changes to the US corporate tax system. Thanks.
So Chris Sims would like to know, if you look at both proposals, the DBCFT and the RPAI, it's always complicated acronyms. Are they optimal in the Ramsey framework, or they're second best?
Well, it depends. I mean, the DBCFT is basically a non-distortionary tax if all countries adopt it. But it's, it's a tax on profits and previously accumulated assets. And so from a nation's point of view, the incidence is on its own residents. So to the extent that a country is acting in its own interest and thinks that it can cause some foreigners to bear some of its taxes, then it wouldn't necessarily be optimal from a private national point of view, but it certainly would be efficient. The RPAI is a little bit more complicated to analyze because it's an attempt to improve on the current system. And I think it would impose tax more on consumers than the current corporate tax is imposed. But it's a little harder to say about and I think it would be more efficient than the current system, but I think it's a little harder to say, talk about it in terms of optimality.
And Malcolm Knight would like to know, given at the end of the day, all taxes are paid by humans, why don't you just get rid of corporation taxation altogether and just tax people?
Well, I agree with that. And one of the things that can be shown is shown in one of my recent papers with Mike Devereux, is that a destination-based cash flow tax can be shown to be equivalent to a tax on the wealth or the returns to capital, other than normal rate of return to domestic owners of assets. Now you might say, well, why don't we just impose the taxes on the returns to domestic owners of assets? Well, some of those assets are abroad, and it may be hard to track down. That's one of the problems that the US faces and would face, for example, in imposing a wealth tax or very high tax rates on capital income. And it turns out, through various international equilibrium conditions, that imposing a destination-based cash flow tax effectively imposes such a tax without having to observe anything beyond what happens in the United States. So it's actually a more efficient and more administrable way of imposing such a tax on persons.
And in terms of implementing it, so the VAT has this nice feature that it's very hard to cheat on it if you're part of a supply chain, and you always have to pay your taxes, but the guy who buys the product from you can deduct it and gets the tax back. Would it be implemented the same way as a VAT? Or?
It could be. There are different technical methods that what you just referred to is called a credit and invoice VAT. There's also something called a subtraction method VAT. The key thing is that you would carry over from the current VAT administration that the only deductions that you would get would be from domestic taxpayers. That is, you would have to have some verification that tax has already been collected in order to get a deduction.
Okay, so then some final questions which came in. So Drogan would like to know, how do you foresee in the future, will be much more dynamic gaming? So we focus very much on static games between the industry and the tax authorities. But given that there will be changes coming up, do you expect a lot of dynamic gaming, and how do you foresee this game playing out?
It's a little bit complicated because once you get into dynamics, you have to think about the games that successive administrations play with each other. So the Trump administration, I'm not sure what they thought the likelihood of being in power the next 4 years, but they certainly were eager to get a tax cut adopted in 2017 and to make certain things very salient. It's noteworthy, for example, that they had a variety of provisions in the 2017 legislation that were temporary for parliamentary reasons. But one thing that's not temporary is the corporate tax rate. And they wanted to make that permanent and salient as a way of making it more difficult for subsequent administrations to change it. So I think it's, for me anyway, it's hard to think about governments engaging in dynamic games with companies because the main issue there is the short horizons of individual governments. And so I kind of think of companies as not so much engaging with a game with a unified government, but trying to anticipate what successive governments are going to do.
And then there's another complication, which is the interplay between the federal government and the states. So let's suppose the federal government were to go for a destination-based cash flow tax. Does it also imply that the states have to switch as well on their corporation tax, or they can just hike up their own individual state corporation tax?
The states don't have to. Many states conform to the federal tax, but some don't, and there's no requirement that states would. However, it would certainly be a way of encouraging states to do it. An analogy I'd give you is that when Canada adopted its VAT in the early 1990s, many of the provinces had retail sales taxes and other kinds of taxes that, the central government of Canada said, if you adopt a tax that conforms with the national VAT, we will, act as a tax collector for you and then distribute the revenue back to you. And there could certainly be incentives provided by the U.S. Federal government to get states to conform. I frankly think it would make life easier for the states as well.
Finally, I have one last question, or a combi question in a sense. So the destination tax, do you see some countries moving ahead, like smaller countries experimenting with it and getting rid of corporation tax, and then being essentially a role model showing the way forward that it's possible? And Young also would like to know, if you look back to the digital service tax, if Europe imposed a digital service tax, isn't it also the case that the US could impose on luxury products coming out of Europe a huge tax as well? And how do you see this game playing out? At the end, it will be just hurting trade on both sides.
Sure. So on the first question, the only way, I guess there are two ways in which other countries have been moving ahead. One, of course, is the digital service taxes, which are a form of destination-based taxes. The other is that over the years, many countries have been changing components of their tax system in a way that simulates moving toward a destination-based tax, cash flow tax. In particular, if you look over time, you'll see countries have raising their VAT rates and lowering their payroll tax rates. And remember that a DBCFT is equivalent to a VAT and a equal wage subsidy. So for a country that already has payroll taxes or labor income taxes and a VAT, it can move in the direction of the DBCFT simply by raising its VAT and lowering its payroll taxes. And so there have been moves in that direction, but there's no small country that has said, I'm going to adopt this. There have been countries, I can tell you from having discussed it with them, there have been countries that contemplated it, but I think in the end, no country has been willing to be the first mover to go all the way in that direction. could the U.S. impose a retaliatory tax rate on luxury products? That's an interesting question. It has been observed by some cynics in the United States that countries that are adopting digital services taxes are designing them in such a way with thresholds, so that have to be big companies and so forth, designing them in such a way that the only companies, or virtually the only companies that are subject to the tax are U.S. companies. That is, they designed them in such a way that the companies that may not be quite as large, that are domestically domestic residents, somehow escape the tax. And the U.S. companies on the list that I just showed you at the beginning are the ones that are subject to tax. And there's nothing, stopping the U.S. other than restrictions of the WTO, which would, from imposing that kind of tax on luxury products made in France or Italy or other places. Again, there is the WTO. I'm not sure how relevant the WTO is these days. It was certainly ignored by the Trump administration. But the U.S. could do that. I would be happier to see the U.S. and other countries moving in a more fundamental direction rather than just engaging in a series of retaliatory tax moves.
So Chris Sims would like to know, if you say, what's the destination of Google and Facebook? Is it based on the advertising, just to get, and then we typically stop the webinar with a positive note. And you didn't give us an answer about the final question you posed in the poll, whether we will see an international agreement. What's your take? Are you optimistic that something like this will happen? Just to give us. I'm not sure whether I put positive note in your mouth or not.
Okay, I will answer both questions. So to answer Chris's question, it depends on which of the taxes. The way it would work under a destination-based cash flow tax is very simple. There would be no additional rules necessary. Imagine that you're a company selling bicycles in France and advertising with Google, and it goes to Google's Irish subsidiary, and nobody pays much tax on the advertising revenue. When you sell the bicycles in France, you don't get any deduction in France for your advertising revenues costs previously paid to Google, and so you pay tax on the entire revenue from your bicycle sales, and therefore the tax is being collected when you sell the bicycles. Now, if you're never going to sell anything, you're not going to buy the advertising revenue from Google, and so it's not really a problem. For the RPAI approach, you would have to do it based on the location of users. So it would be the same kind of approach that's taken under the current digital services tax. In terms of optimism, I think international cooperation is not going to succeed in terms of every country signing on and adhering closely to something negotiated by the OECD, because, as I said, I think their approach is too unwieldy and it's trying to make too many compromises. But that said, I think it does serve a useful purpose of focusing on certain kinds of tax reforms, which I think both of them have some merit, and I think countries that sort of have an eye on what the OECD is proposing and what the U.S. did in 2017 and thinks about improvements that move in that direction, as well, in addition to the ones that I mentioned that adhere to destination basis, we'll be moving in a better direction. And I think ultimately, one of the things that has always concerned me about tax reform discussions is, demonization of corporations that take advantage of tax rules the way they're written. And I think if we focus more on making tax systems work better by design, and less on blaming companies for acting in their own interests, I think we'll make progress.
Thanks a lot, Alan. I think we have learned a lot, and we have also, as a side product, figured out a lot of these acronyms. But I think it's a complicated issue, but at the end, it would be nice to have a simple destination-based tax system, which seems to me a big bang solution, but perhaps sometimes one has to go for a big bang, and if there's a path in and a gradual approach, perhaps that's the way to implement it. Thanks again, and it's a fascinating book, so I hope that everybody who is interested will buy it or just download it from your website for free. I'm not sure whether it's very incentive compatible to buy your book, but it's a good public service, and I think it's good for the world. Thanks again, and hope to see you in the real world soon, and appreciate.
Thank you, Markus.